one of the innovations we've looked at in the structure of deals is the increasing use of clever mechanisms to hedge risk, to improve the nature of the negotiation, and to isolate and set aside risk in different ways. And this discussion is one that we love because it's right in the detail, and it's to look at this really critical negotiation point of risk allocation and how can you improve the performance of the transaction, but even beforehand, improve the performance of the negotiation. And Aartie's going to lead us through an interesting discussion on some of the different ways in different types of deals that could take place. So take it away and introduce yourself, if you would.
Great. Hi, everyone. Thanks so much for taking the time to join us in this discussion. So my name is Aartie Manasingh. I'm a director with the Willis Towers Watson Transactional Liability Group. Just by a little bit about my background, and then I'll have our esteemed panel members introduce themselves. I've been with Willis. I joined at the end of last year. Prior to that was a M&A underwriter, and prior to that, a practicing M&A attorney, but have been really excited to join the world of reps and warranties insurance, which we'll talk a little bit about today. Alan?
Sure, I'm Alan Konevsky. I'm the Chief Legal Officer at tZero. tZero is a financial technology company developing blockchain-based solutions for the capital markets. In my role, I look after, among 12 other things, strategy and deals. Before tZero, I was at MasterCard, where I looked after global strategy and M&A, as well as technology and operations, and covering those two divisions and two teams. Before that, I was at Goldman Sachs, looking after principal investing in Europe. And before that, I was an M&A and private equity lawyer at a law firm in London and New York for 11 years.
Good afternoon, everyone. My name is, I guess it's still morning, good morning, Zarifa Reynolds. I am the head of corporate development at TIAA. For those who don't know, TIAA is a Fortune 80 company focusing in the financial services sector. Historically, the company is known for providing retirement benefits for higher educational institutions such as this one, as well as folks in the nonprofit sector. Prior to becoming the head of corporate development at TIAA, I was the head lawyer for the team, working on M&A transactions. And over the course of my 5 or so years at TIAA, I've executed about $10 billion or more in acquisitions, and also about $6 or $7 billion in financings related to those acquisitions, all in the US. Prior to joining TIAA, I was a partner on the corporate side at Greenberg Traurig in New York and Miami, Florida. It's a pleasure to meet you all and talk to you today.
Hi, I'm Brett Shawn. I'm an assistant general counsel at Warburg Pincus. Warburg Pincus is a global private equity firm focused on growth investing. My role at Warburg, I'm basically in charge of all the deals from a legal perspective. So whenever we buy something or sell something, I'm intimately involved in that process. Been at Warburg for 4 years, and before that, I was an M&A lawyer at Wachtell Lipton in New York for about 5 years.
If you're interested in additional information on innovation and M&A, I encourage you to check out the Transaction Advisors Institute, which is a robust source for knowledge on M&A best practice.
We host a series of M&A conferences, run an elite M&A academy, offer M&A masterclasses, conduct M&A research, organize the M&A Leadership Council, and publish a prestigious M&A journal.
Members of the Transaction Advisors Institute include corporate executives, board members, and private equity investors that are interested in understanding the critical issues impacting transaction planning, structuring, and execution.
I encourage you to get more involved in the Institute.
Okay, great, thank you. So just as an overview of what we're going to be discussing, so we're discussing the deal term negotiations between buyers and sellers, and what remedies can really bridge the gap, in contentious negotiations. We're going to have a discussion up here, but please, ask questions at any time, and don't be shy about that. We'd love to get your input. We have so many, different backgrounds in the room. But just to start off the conversation, so let's start at the very beginning of a deal, pre-LOI. And Zarifa, this might be a good question for you. So given the asymmetry of information available and the uneven balance of power between buyers and sellers at that point, how are you identifying what your key concerns are or your key, previewing what might be the more contentious negotiation points?
So I want to take a step back even before that, because the team that I sit on and support is the corporate strategy and development team. So I head corp dev, but the corporate development or the M&A function at TIAA is largely tied to the overall strategy of the company. So when we're not executing deals, we're helping the C-suite and the lines of business kind of to develop their overall strategy for how they're going to grow the business and maintain the market share that we have, particularly in higher ed where we're a leader. When we look at M&A transactions, it's largely to fill gaps within our organization that we can't fill through organic growth. And so there's always a very strategic component to why we're doing what we're doing. And the transactions that I mentioned, the $10 billion or so, were specifically to fill those gaps. So we were historically an in-service asset manager, just serving our GA, our general account, and knew that where the market was going, you needed to be more of a scale player within asset management. So we executed a transaction, Nuveen, $6.5 billion, to kind of grow our third-party business and to fill gaps within asset management. We had a relatively small bank, and we wanted to kind of service our clients in a more holistic perspective. So the strategy around that transaction, the Everbank transaction, $2.5 billion, was to become a more robust bank. So starting with strategy first is what we do. And when we identify a strategy where we need to engage in inorganic activity, we identify targets, we work with our investment banking colleagues, and we do what we call sort of preliminary or desktop due diligence once we think we're going to we found a suitor, a partner that we want to dance with. And we identify risks that are related to the company, but also related to the overall strategy of what we want to do, high, medium, and low. So even before we're executing the LOI or the term sheet, we have sort of this risk assessment framework that we use internally within our organization. And we bring in both the functional areas and the business partners in terms of doing that assessment. At the beginning of a transaction, that team is relatively small, but over time, when we get to kind of negotiating the actual contract, we bring more parties into the diligence process, and we continue to run that risk assessment, high, medium, and low. When you think about the remedies section, and I don't want to get ahead of my colleagues, those are meant to kind of address things that gaps in the risk assessment or high risk items that come out through diligence or throughout the contract negotiations. And this kind of risk assessment framework that we do throughout the process, I think, help us to be more efficient when it comes to kind of figuring out what are the carve-outs to the reps they're looking for, where do you need to have those indemnification protections around those items, and in the off chance that you need to use kind of rep and warranty insurance to solve for that, how that all plays out. I'll pause there. I think I said a lot, and let my other colleagues chime in as well.
Brett, is that consistent with your experience, or?
Yeah, I mean, we're a financial investor, so when we're making investments, we're not necessarily looking for something to bolster what Warburg Pincus itself does, but it is similar in the sense that our deal professionals go out and develop general theses. So for instance, we think there's growth in business-to-business SaaS software. So we'll have an idea of the sorts of businesses that we're looking at, and we'll refine that sort of at a macro level, and then we'll look for businesses that we think match that thesis, and then you find a specific business, and then you drill down to see, okay, what are the quality of its earnings, what are sort of the specific risks that business might have, and then you go into the NDA process, and you do the more specific diligence around that particular target, and then you get into the the brass tacks of negotiating the specific structure of the deal after that.
Yeah, look, I think that's very much spot on, and I think you talked about asymmetries and various disequilibriums that naturally exist in a deal ecosystem, particularly up front. And ever since I became a blockchain guy, which was about 6 months ago, I tend to think about trust ecosystems and circumstances where people or institutions come together to engage in activities where there's a trust deficit. And that trust deficit can be caused by informational asymmetries or other kinds of imbalance. And what we're really talking about here is how do we fix that trust deficit, that disequilibrium? And I think we'll get to the kind of the various mechanisms that get into deal papers and beyond in a second, but it is absolutely spot on to say that the way you fix them from the beginning is to look at strategy, due diligence, holistic assessment of risk in a thoughtful, balanced, and proactive way, and then focus on integration, right? If you think about these things up front, if you think about strategy up front, if you think about due diligence up front, somebody on the last panel talked about 21 work streams, and I think 21 is a nice number, first of all, but second of all, it just shows you, how important this is and how connected these panels are. If you don't deal with strategy, if you don't treat diligence seriously, and there are some circumstances where you may not have that luxury, and we can talk about that in a bit. If you don't think about risk in terms of probability and magnitude and in a holistic way, and you don't think about what you're going to do with the damn thing once you bought it, so integration. For a financial investor, it's a little bit different, but you think about your plans for how you're going to realize value for your LPs. The tricks that you're going to use in the contract to deal with the issues are going to be of fairly limited value. And so, but if you get the first principles set, strategy, diligence, risk analysis, and integration, then the process will flow in a far more natural way, and the mechanisms you'll need to deploy are going to be far more targeted, far more effective, and hopefully will never be used, right? That's ultimately the proof of how effective the process is, that you will never use any of the stuff that we're going to talk about.
Right, so you're sort of tying sort of the due diligence process to particular remedies, which I think is what we should be digging into here. So Brett, I'll ask you the question. So what remedies and protections are you more focused on in a process, or how are you making that decision between holdbacks, special indemnities, use of reps and warranties insurance? Broadly, how are you thinking about that?
Yeah, so I guess there are a few things I think about. So if you're coming into the deal and the first thing you're thinking about is like, how am I going to get some sort of post-closing remedy? There's something is wrong with the deal. So I think the first thing I look for and I think one thing that mitigates a lot of risk for us, and this may be different for a lot of strategic buyers, but we always look for a lot of alignment, post-closing alignment between us and the management team. So we're almost always going to insist that the management team, if they're taking out proceeds, they roll a significant portion of the proceeds into the business, so that then they're standing shoulder to shoulder with us, and if things don't go well, they're going to suffer that too. They may even suffer disproportionately relative to us if things don't go well, because we'll be in a capital position, they'll be in more of a profits type position. So I think deal structure is probably the most important thing to sort of get you comfortable from a post-closing remedies perspective. And then after that, I would say, it depends on the sort of risk that you're dealing with. So if it's a very specific known thing, like litigation, then I think obviously rep and warranty insurance is not going to be an option, because you can't insure a burning building, the famous example. So then you're going to look for some sort of specific indemnity. And then the question is, well, do you want a cash holdback so you don't have to pay them the money until everything looks okay? That's obviously a clean way to handle it. But a lot of sellers are going to want to have their money immediately. So then you could look for an indemnity from the seller, and that depends on how creditworthy the seller is. It also depends upon what your appetite is for, if that seller is someone who's running the business, do you want to be suing the person who is your partner if things have gone generally well, but you have one little problem? Do you really want to say, hey, business is going great, now pay me $5 million, please? Like, that's not a nice thing to say. And the other way that you sometimes handle discrete issues is you can have a valuation adjustment. So management rolls and they have 10% of the company, but if this particular lawsuit goes the wrong way, then you drop them down to 7% of the company. And that can be an elegant way to solve things, that you don't have to fight over someone paying cash to one person or the other, or at least not until the exit. But one of the weaknesses of that is that if the company itself has a cash shortfall, that mechanism doesn't generate cash. So you'd still have to, as the majority stockholder, you still may be in a position where you have to finance the actual cash loss that the business has suffered. So I think those are kind of the general tools and how I think about them.
Aartie, can I ask a quick follow-up question of Brett, if you don't mind? Sorry to interrupt. You mentioned in the beginning of your remarks that you like to see a significant rollover. Can you tell us in terms of numbers, sort of what percentage, and does it work better if it's bigger? And if so, what point too is the tripping point where it just isn't enough to be material?
Yeah, it's a great question. I would say, usually the role is on the order of magnitude of anywhere between 25 and 60%. I would say that probably, it depends on the deal. It depends on what the stake is of the management person, who the management person is, how much they're going to roll. Usually the CEO want them to roll a lot. It depends. But generally, even companies where we're the only sponsor, usually our ownership is under 90% usually, I'd say, because of the size of the role.
And I would say even for strategics like ourselves, particularly the big asset management deal we did, everything that Brett was saying is definitely applicable. We had an earn out in that transaction, largely because we wanted to keep management's feet to the fire for the payout that they thought that they would be able to give us in terms of the value that they would bring. So certainly asset management transactions are ripe for the types of mechanisms that Brett was describing, and we've seen them even as a strategic buyer.
Yeah, I think that's, it gets to the point of what's your starting point for this analysis? Is it, I've done all the work I can, I know there are specific issues, they may or may not happen, and I want to share the risk. I want you, management, to be on the hook for that as well, directly and indirectly, whether through continued equity ownership and rolling into the deal, or whether clawbacks or other kinds of arrangements if something happens. Because you know more about it than I do, and first of all, if I tell you about that up front, you may be more upfront with me in due diligence. And in any event, once we get to the irreducible maximum on that, you will remain incentivized to deal with these issues if they do materialize. Or as a starting point, you know what, I have no idea what might happen. I'm just going to assume I'll never find out. These people may or may not know better than I do. I'm just going to hold them responsible, right? That's a bad way. And the first one is a good way. And the first one is an output of the kind of exercise that you were describing. So.
Yeah, I'll mention one other structure that we actually use a lot is seller financing, I'll call it, or a sort of big holdback, where if we've done diligence, business, the actual macros of the business are very good, but the company itself is a young company, doesn't have needs to be professionalized to a great degree. We're sort of done diligence, found a few things, but you can do diligence all year and not find everything. To mitigate those sorts of risks, what we'll do sometimes is we'll say, okay, we'll pay you half the purchase price today, and we'll pay you the other half over the next 2 years. And we may or may not ask for the ability to offset that against indemnity claims. And that is the benefit of mitigating your risk, particularly if you can offset it against indemnity claims. And it also, as a financial investor, boosts your IRR. So it's a double benefit for us that we sometimes use.
Yeah, but I guess that's probably less about trying to silo away specific risks, however broad or narrow, and more about just valuation.
Yeah, I think that's right.
This is just a pricing mechanism for a deal.
Yeah.
Where if you have to agree on a number now, you won't, and therefore you defer it.
Yeah, I think you guys raise a really good point, because one of the chief risks that any person buys something wants to solve for is not paying too much money for it, right? So the mechanism of having the seller earn it over time is one that's that solves that key risk of not paying too much money for something. And you don't know what you don't know. Getting back to our first point around asymmetric information, and so I think largely as a buyer, which we've been in at the TIAA, we're always trying to kind of figure out how we can make smart decisions for things we don't know and we can't even anticipate might happen or occur with a particular company.
And so, this is a biased view based on the deals that I see come through the door, but, just given where the market is and, I'm sort of setting up for talking about reps and warranties insurance, but prior to that even, given sort of the uneven negotiating power between sellers and buyers, how are you handling, sellers who are resistant to a larger holdback or, who want these clean walkaway deals now? And, what are your techniques for managing that?
Yeah, if they need a clean walkaway, which happens a lot, particularly if it's one sponsor selling to another sponsor, and even strategic selling to sponsors are jumping on that bandwagon. yeah, I mean, rep and warranty insurance is an option. And you actually, I mean, I'll pitch rep and warranty insurance a little bit here, which is that, if you're dealing with the market is booming, as I'm sure people have heard, and the insurers are all, want to make a name for themselves. So at least the lore out there is that it may be easier to collect from an insurer who wants a reputation for paying claims than it is to collect against a seller of a business. And we've been through we've settled one claim and are in the process of going through another claim right now. And I would say, based on my experience, it's a long but more pleasant process than litigation against a seller, at least based on my limited sample size. So it's a nice arrow to have in the quiver to give the sellers a walkaway deal. Although it's not going to cover things you know about. And if the company has a lot of issues and the insurers see that, we've seen them sort of take a step back generally and not even put in specific exclusions for the things they see, but say, I can tell that the company just doesn't have good policies and practices in general, so here's a whole area I'm going to exclude. And that's, once you see that, then you really have to take a step back and say, the insurer's not going to take this risk. We as a buyer don't want to take this risk, so let's think about some way of sharing it with the seller and go to the structures we spoke about before.
I think one of the interesting things in the one situation we were talking about where we actually consider rep and warranty insurance in a transaction is it kind of helps you to further your due diligence, because the insurer is definitely kind of digging in if you're trying to insure one particular risk on that issue in a way that and have experts in that particular space in a way that a strategic large financial services company such as TIAA doesn't have that kind of depth of the ability to probe and kind of dig in. So we actually found when we were looking at doing it for a deal that they actually uncovered some stuff that we hadn't even anticipated. So that's maybe a benefit.
The insurer said, have you diligence this?
Correct.
And good question.
Correct.
Let me
Correct.
pull in my expert to diligence that, and then they're like, we found this.
Correct, because insurers are, particularly if you're trying to insure one particular risk, which we were for this transaction, they really can dig in and help you make a better informed decision. Not that that's the reason why you would use insurance, but it's just an added benefit to that negotiation.
Yeah, I think, look, the kind of the no recourse bandwagon that you were talking about, which, by the way, was built by private equity mainly, and public companies and public deals, in kind of the public company deal context, for good reasons, and private equity deals for reasons that private equity managed to convince the rest of the world are good reasons, has been creeping into private deals as well, where the model is, well, you know what, I want clean recourse, public style, and I don't want to have to deal with this. And there, if you have to think about it analytically and intellectually, there isn't a good reason, right? A public company may not want to have and may not be able to have post-closing obligations, or its former shareholders.
Correct.
Right? A private equity fund will talk to you about fund life and all this sorts of stuff, which may or may not be true, usually not. And then
it's true.
Well, I think we have to.
Who wants you sell a company, you pay your LPs, you're going to call the LP 2 years later and say, sorry, just kidding?
So part of my role includes corporate VC, which I didn't talk about in the introduction, but I'm sympathizing with Brett here because the PE firm, we do VC, but it's very similar. The PE firm has a life of the firm. They have clawback mechanisms in the documents that exist for a period of time, but it's a very limited period of time. And so after that, if you don't have clean deals in private equity, the private equity shop could find itself in some real problems.
Yeah. And also, I think we view ourselves as a financial investor. So we're not in there running the company. So we don't think it's fair that we're responsible for the operations of the company.
Sure. And look, I think then, but in a private deal, I think those reasons are far weaker. And then you get into purely an argument about leverage, right? Who wants it more? And then you back into a situation again that we started with. If this is a strategically important asset for you, and you've done due diligence, and you know what you're getting into, and you know what you're going to do with it after closing, it might be a risk that you're willing to take on no recourse basis, so self-insuring, or you may be able to go to a third-party market and buy policy. And then you have to do a gap analysis to say, well, look, this is what I would have gotten from the seller. Kind of the nirvana view is that kind of seller indemnities cover everything. They don't. But whether you have indemnification or whether you have you just have recourse at law and you have to go sue for damages, those things are not carte blanches. But you line that up against what the policy covers and doesn't cover, including in things like regulatory matters and environmental. And then you identify gaps, and then you may choose to self-insure those gaps.
Yeah. Right. The interesting thing about being kind of in a strategic situation, which is a bit different from my colleagues, is when you think about insurance, if you're really buying a company for strategic reasons, even if you insure the risk and it comes true and you get your money back, I mean, like, what's the point, right? I mean, like, we bought this company because we wanted to be bigger in asset management, to be able to kind of service third-party clients and to kind of really have be a scaled asset manager as part of our overall strategy. Or we bought this bank because we wanted to kind of be able to provide a whole suite of financial wellness products to our clients. If that doesn't happen and we get insurance money, I mean, it doesn't really feel the same way as a strategic. Which is why for us, like, the risk assessment and the diligence process up front is just so critical, because insurance doesn't really make us whole. Even though you can get your money, it's not making you whole in terms of why you were doing the transaction to begin with.
Yeah, look, I think it makes a credible story from a fiduciary perspective of, we've done all this work, we've thought about risks, and this is how we're dealing with them. But to your point, does it really make you whole if something doesn't work out? Not always.
So just taking sort of a step back from that, and this is, of course, just my plug, but when I started underwriting in 2014, reps and warranties insurance was used in about 500 deals. So in 2018, it was used on over 3,000 deals in the marketplace. And we've had some top law firms, top M&A law firms tell us that they use insurance on over 50% of their deals. So something is driving that process. And Zarifa, to your comment, we're seeing a shift where it's about 50-50 between private equity firms and strategic firms, right? So we spent some time in, there are a couple of questions that arise out of this, but we spent some time sort of talking about, well, there are situations where it's really the policy and, what you might get from a traditional seller holdback are not back-to-back. But, Brett, because I know that you use it, when you do use it, is this like a happy decision? Like, what is driving it? Or is it just really your final, A
happy decision. So I would say, if we're buying from a sponsor, we know that you're not going to get an indemnity from them. And even if you're buying from a strategic, yeah, maybe you can get an indemnity, but, how do you feel about going and collecting it? It's like not something you like thinking about. So, I feel it's a little bit of comfort to have the rep and warranty insurance, but it's also, you're paying good money, and most of the time you don't use it. So I think, some deals, the diligence is clean. It's a company that's been, owned by 3 different financial sponsors for, 15 years. A lot of times we just self-insure those, and we take the risk ourselves. So, I would say it's, it's sort of nice to know it's there, but I'm always sort of questioning the value of it in that particular case.
So I'll be more direct and say it's not a happy decision. I think insurance is a last resort item, in my personal view. I don't find it to be a place where I want to find myself. I think that the way that these contracts have been structured over the hundreds of years people have been doing it, there have been protections built in to try to kind of do that dance between the buyer and sellers and solve for kind of risk assessment and asymmetric information. I think the insurance adds another element to it that's, I personally view it as more of kind of a last resort item, and I'm not really happy if I have to go there. And as a strategic, it probably is not going to make me whole if I have to collect on that claim anyway. So that's my perspective.
I mean, the one nice thing that it does, and any underwriters here should close their ears for this, but you'll generally will get better reps from a seller if they know that they're not, on the hook, except in the case of fraud, than if they're actually on the hook. So by saying, hey, we're going to give you a walkaway deal except for fraud, and we're going to go get insurance, so we want to have a great insurance, a insurance policy that covers a lot, please give us, more reps. And that's a conversation that usually results in good reps. So I think it helps you, and indirectly that helps you get better diligence because the seller's still on the hook for fraud, so they're going to care about the reps they're giving you, and you have a real reason to tell them to give you more reps versus just a totally walk-away deal on both sides.
Yeah, and I guess the moral hazard that creates, you guys deal with it with the underwriting process.
Mm-hmm. Right. I like to tell this story, but so when I was an underwriter, you used to get draft purchase agreements for review, and every once in a while, someone wasn't really paying attention to the draft that they sent you, and it would be the seller's draft, and there was a footnote that said, we'd normally not be comfortable giving this rep, but since you're getting reps and warranties insurance, go ahead. Which is, as an underwriter, I was like, no, but that did happen.
Yeah.
Sort of on that same note, Alan, I would talk to you about this.
Quick question. Could you just give us one or two examples? When you're talking about better reps, you both mentioned it. Can you give us an example of which reps would be better, and give us some detail if you could?
I mean, the no undisclosed liability rep, I would say usually, we'll get a non-GAAP qualified no undisclosed liability rep in a walk-away deal, and then, the insurance will cover that.
Just sort of a reduction in, normally knowledge qualified reps or look back periods instead of 5. You're seeing like sort of indefinite look back periods, things like that. So just, obviously more buyer friendly.
Yeah, but then I think the insurance policy will build back some of the qualifications, including with respect to knowledge.
Well, so the insurers, yes, will comment on the reps, but again, in 2014, there were 5 markets. In today's market, there are 23 underwriters, sort of competing for business. So if you're not going to be a commercial underwriter, you're not going to get the business, and you want it. So there's a give and take there, and what we've seen is that these policies are working. They are becoming sort of more back-to-back. And to Brett's point, I think that the underwriters in the space approach it with the awareness that they're going to have to give sort of more buyer-friendly reps. They're going to have to cover those.
So I think the one perspective that we haven't talked about in the insurance context is I think in the deal negotiation phase, it may lead to more efficiency, but if you actually have to effectuate on the insurance policy, it's going to lead to a lot more inefficiency. And so I think as a strategic buyer, largely TIAA, like we always think about, the front end versus the back end, and is it worth it to kind of have a more efficient negotiation process with cleaner reps, less fighting, and on the back end, if you actually do have a problem and you have to get in there with the insurer and figure it out, and it takes a long time, and you're trying to get the synergies that you thought you would get, you're trying to integrate, like how disruptive is that into the process? And so when you asked your question about being happy about insurance, I'm like, no, I'm not happy about insurance. Because it could make my front end process more efficient, but on the back end, if I actually have to ever use it, I wind up in a much worse situation. And I'm at a company where I've been there for 5 years and will be there for a while. So we live with our decisions. We're not like Brett in private equity where you live with your decisions for maybe 10 to 12 years, but you don't live with them forever. I mean, I guess strategics actually could sell what they buy as well, but then that's just sort of a churn, and that's not the type of company we are. So it's just when you've been around for 100 years and you're doing things for a particular reason, you're thinking about it in a very sort of more deliberate and somewhat different way than some of the other panelists here. I'm making Brett think.
No, I'm just.
He may disagree with me, but this is
okay. So if you have a problem, if you're not going against the insurance, how are you dealing with it, and how is it easier?
Well, I think that the indemnity mechanisms and sort of the clawbacks have been around for so long that it's kind of tried and true. I feel like in the insurance space, it's not as clean, and I think that there's.
You call them up and they just say, "Look, you breached a rep, pay up," and they're like, "Sure, here you go."
No, I mean, well, you pre-agreed to who's gonna look at. So if it's a financial issue, you pre-agree with who the auditor is going to be. Mm-hmm. You have pre-agreed to definitions around EBITDA and the other various metrics that you're testing against. And there's going to be a little bit of a dance, but ultimately you're probably going to wind up in arbitration or something, and you're going to have kind of a decision made. That's very different than kind of dealing in an insurance context with an insurer who will be a third party. Then you're going to have the person looking at the financials and auditing them. Then you're going to have the buyer, and you're going to have the seller. You've introduced more complexity and more people to the process than was there before. And it's not a mechanism that, in my personal view, it's more new. It's not sort of tried and true in the way that the indemnification provisions in the time that I've seen are sort of tried and true. And I've been in situations where we have had a discussion around kind of somebody needing to pay out an indemnity claim. And it does take a little bit of time, but I think the insurance context takes potentially more time.
Yeah, I think that's, I think, well, first of all, just to be clear, we all love private equity. This is not,
Oh, yes, we do.
and we all love transaction insurance. And so, but it is true that when you go and talk to a board and you say, this is a deal, and these are the terms, we got reps and warranties. Oh, by the way, we have no seller recourse, we have an insurance policy. You're gonna get asked, what's wrong with this, right? Rightly or wrongly, people, particularly people who've been around for a while, are in the frame of mind of insurance, to your point being last resort for something that's problematic. Again, in public deals,
It's different.
where private equity is involved, maybe it's
different.
different. But when you're dealing with a private deal where the seller is just saying whether the seller is a strategic or a family or whatever it is not giving any recourse, people are going to say, oh, what's wrong here? This is like an as-is deal. There's something wrong. Why are we paying full value on a multiple basis for something that's a problem? Because, hey, you had to go get insurance because they wouldn't even stand behind it. Right? Some of it is psychological. People have their habits. Directors who've been up for a while have their habits, but that aroma is definitely there.
Yeah. Well, I can understand the unfamiliarity with it, which is why we're having, in part, this conversation. And to your point about claims, which we should talk about, which, whether those are claims against a seller or claims against the insurance company, we've seen claims paid out in as quick as 6 to 8 months on, multi-million-dollar claims. It used to be the case that, Zarifa, you were right. Fighting with an insurance company, it was going to take a really long time. That's not the market we're in right now. You do see claims paid fairly quickly. And I don't know if anybody has any sort of claims war stories that they want to share. You're welcome to, Brett. I know you've been through too, but we're also seeing claims where a multiple of damages has been applied, and I think that has been another concern that has arisen. Is well, the insurance company, they might pay a claim, but there's no way we're going to get our multiple. I can't say either way, but we've seen it happen with more frequency. So I'll just pause to see if anybody has any thoughts before we sort of move on to the next. I don't know why I'm looking that way. I feel, someone there has used reps and warranties insurance, but okay. So, go ahead.
I think you're right that maturity of the industry and claim history and claim collection history has had a lot to do with increasing acceptance of it, and will continue to. So that, the point that we all made earlier will reduce in impact over time. Because initially people thought, great, I'm just buying a lawsuit against Lloyd's of London, right? That's all I'm doing.
Right.
And it'll take forever. But as claims have been paid, I don't know if 6 to 8 months is fast, but as claims have been paid, and again, people may have in their minds, well, if I have an escrow, I can just ding it pretty quickly, which is not always the case. But as people see that this has value, and you're not just buying a lawsuit against a large insurance company, the perception will continue to change.
Yeah. I mean, our first claim took about, let's say, like 4 or 6 months to get done, and it was a $25 million policy. We made a $25 million claim. We got paid, around $17 million, and the reason for the delta was there was some disclosure in the disclosure schedule that was ambiguous and arguably hit at the issue that we were claiming about. We didn't think it did. The insurer had, an argument that passed the smell test, but we thought was wrong. But we ended up settling there, and it was a long but relatively pleasant process compared to a dispute with a traditional dispute with a seller, I'll say. And the current one that we're going through right now, I think we're up at like month 9. It's still going on. It's a very large claim. We're making a multiple claim. So a lot of the focus, the rep is clearly breached, but it's like a $5 million misstatement of EBITDA, but our multiple is double digits. So our claim is very large. And all the questions from the insurer are about, how did we actually value the business, and looking at our investment decks and our models. And they hired their own outside financial advisor. We have our own financial experts involved. So it's a extremely detailed and drawn out process. The insurer is, making tons of float, but it's a professional process. You don't feel like you're fighting with an insurer, but it's not the knockdown drag out yet that we've seen in other types of disputes. But we haven't been paid yet on the second one, so we'll see.
Yeah, I mean, everything depends on the nature of the claim. So we just saw one recently where right before selling a company, the seller switched accounting software, and there was some sort of glitch where they were just double counting revenue. Or it's a pretty big glitch. So buyer buys a company, gets in there, and within like 2 or 3 months quickly realizes, well, there was an issue. So they applied sort of a multiple, and they got paid out. That was the one that I'm sort of referencing that happened within 6 months. There was just sort of no dispute to it. So it does.
So they paid whatever they asked for. They paid all that.
They did.
Wow.
They basically just there was no.
It was a glitch. So there was no. Did they waive subrogation? Did they threaten fraud against the sellers, or no?
They didn't. They didn't find a reason to believe there was any fraud on it.
What was insured? Like what was actually insured that allowed? Like what rep?
The financial statements rep.
Financial statements rep. Okay.
Yeah. And so, a lot of this has to do also with, the buyer presenting a claim to the insurer that's, fully baked and, has sort of their argument laid out. But the other thing that I want to talk about, and this is in the context of insurance, is, and Alan, you mentioned this, so we'll start with you on it, but does sort of the remedy that you're using to get through these contentious negotiations, does that affect your diligence process at all? So if you're using, insurance, or the seller's giving you a holdback, are you performing less diligence, more diligence? Do you care?
I think I am agnostic on the post-closing recourse mechanisms I'm going to have. To get back to what we started with, I think due diligence and strategic assessment and risk analysis, integration planning are there. They're constants, right? And what may impact them are other factors, like the
Public company.
the sale dynamic, the nature of the people you're talking to. That may impact it in terms of how deep and how quick or slow it is in terms of the process. Now, but I don't think you would say, you know what, I'm getting an insurance policy, I don't care. It's going to work out because, for one thing, you're going to want to see work. And I want to see work. It's not a successful deal for me if I have 14 claims for an insurance company post-closing. First and foremost, people are not going to say, good job for buying an insurance policy. They're going to say, why didn't we diligence this? And so I don't think it changes. And to be honest, if it does change, it's probably, for you probably are doing bad deals.
Absolutely. I would not change a thing about diligence.
Yeah, I agree.
It's
Yeah, it's a
feel a lot more comfortable, that you're going out to do the rep warranty insurance. Oh, sorry.
yeah.
I think that's right.
I was just asking if it changes your access in
Yeah.
the diligence
Fair
process.
point. You mentioned that before. You get people all of a sudden more receptive to giving more reps. I think they may be also more open, the management in particular, in a roll situation or some sort of a clawback or an escrow situation. If they're facing that or an insurance policy, they may be more transparent with you because their personal financial security is not at risk. On the other hand, it's also individuals. So.
Yeah, I mean, it depends. I don't know if it's like a totally categorically correct statement, because if you find something, then the insurer is not going to cover it. You need to negotiate. But as a general matter, the excuse, why do you need to do all this diligence? Well, if I don't do diligence, the insurer is not going to cover anything. So please let me do a diligence. I'm not trying to go after you. I'm trying to get insurance. I think that is persuasive.
Yeah, and I think, again, rightly or wrongly, people think, well, you know what? My money is not going to be at stake here, so I will talk to you. Now, of course, if you find something, you may walk away from the deal, and so whatever value-enhancing transaction is on the table, including for the management personally, disappears. And you're right, even if your reps all of a sudden get denuded of knowledge qualifiers and look like something you pull out of a buyer's form in a book, the insurance policy will build a lot of that stuff in anyway, whether because they comment on the reps themselves, or whether that's just the terms of the policy. So I think it's tricky. I think on the balance, it's more likely than not people will be in a better disposition to talk to you.
So we talked a little bit about this earlier, but is it safe to say that reps and warranties insurance, I'll say it, is the most innovative product that has come along to bridge the gap in contentious negotiations between buyers and sellers? We have quite a big focus on M&A tech. We hear about it all the time, but are you seeing in your respective practices anything that's really addressing this issue?
The most innovative product. I mean, it's insurance. It's not how innovative can it be? I mean, sure, it's innovative.
Brett, I know you love insurance. So.
I'm going to ask your question as a question. So what I would think is that the insurance companies are kind of using AI and other ability to kind of read data and interpret data in a way that may be useful from an innovation perspective. I, like Brett, don't really find the concept of offering insurance as innovative, but I think that if insurance companies, if this is now market and insurance companies are doing this repeatedly, and they're coming across the same issues repeatedly, then they could presumably kind of build a mechanism where they're using kind of the ability to understand and read data to make better informed decisions. And I think that that's innovative would be what where I would go with it. But I'm curious to see if others have a perspective, or even if anybody in the audience does. But that's where I think the innovation comes in.
Yeah, I think so. And look, I think we talked about trust ecosystems before, and that M&A is an example of that. And the way people have been dealing with that before is through sort of kind of due diligence, intermediation, including experts like lawyers and accountants and other forensic experts and bankers. And at the end of the day, some sort of risk sharing for the known unknowns and unknown unknowns. So whether it involves the person you're dealing with or a third party like an insurance company. But we still acknowledge, and this is not a dig at the insurance piece of it, the system is still inefficient. It is in terms of cost, in terms of time, in terms of failure rate, right? And so you don't have like this, the killer app doesn't exist yet. I think for some pieces of what's involved in the due diligence exercise, like inventory management, the more you shift to, this is not a plug for blockchain, or if it is, my company doesn't do that piece of it anyway, but inventory management through distributed ledger technology may help, because there's at least one piece of what you're diligencing that's less susceptible to somebody screwing up and changing software or lying to you. And as more pieces shift to verifiable technology-based mechanisms that cannot be manipulated, and that don't require a lot of intermediation in order for you to get comfortable with it, that'll help. I think thinking about risk holistically, and people are pretty bad at thinking about risk. There are various heuristic and other biases that we have. Careers, we want stuff to get done. But shifting that to analytical tools like AI, and insurance companies are very good at thinking about risk, that's your business. Other companies less so, is going to be helpful. So I think you're not going to see a killer app. Okay, you want to do a deal, push a button and it gets done. But you're going to see pieces of it that are going to get automated in a way that doesn't require as much intermediation and all the inefficiencies and friction that comes with it.
Now, and to answer your question, so much of this is, so as part of the insurance process, we're just, we're looking at the buyer's diligence,
right.
and that it just requires like an actual M&A attorney to sit there and kind of make that analysis. So we haven't seen any sort of tech innovations. We've seen one product that's sort of been floating around, I'm sure you all have too, where they'll read the reps, they'll have artificial intelligence read the reps and sort of point out and highlights what's more buyer friendly, what's more seller friendly. That doesn't really help us, but that's interesting software. So
what software is that?
So I don't know the name. There are a bunch of different companies that have sort of come through and tried to pitch this to various underwriters, but I don't have a name's not coming to mind.
Yeah, well, and I know Intralinks is working on some development in that area to not only diligence change of control provisions and other elements, but also then to have a life cycle, so that as you look back 2 or 3 years when there may be a claim, because I think the claims are they 12 to 18 months post-close? Is that typical?
12 to 24, I think.
Right, 12 to
12 to
24, if you're
24.
not using insurance, you can get
Longer.
up to 6 years in coverage.
Well, it was interesting, as Brett said, at that point you're going back and revisiting what was the basis in which your multiple calculation was predicated. And if your EBITDA analysis was flawed fraudulently, then the application of that deal logic is really critical. So to preserve the history in a common platform is obviously going to be, arguably, again, a best practice. It's not as a file server, but is really part of this new platform design. So it's, it's not just changing deal structure, but in techniques, right? In thinking about the longevity, which of course, as a strategic, you've got that good long-term thought. So.
How many claims are actually made? Maybe this is more to Willis.
Yeah, so,
On the insurance, we're talking about the mechanism, but what's the percentage of claims made on those policies?
It's a little bit of a hard question to answer, not because I don't have an answer, but as you all know from being M&A practitioners, it's not really the number of claims, it's the severity of the claims that really counts. So in terms of policies, you'll see a claim on 1 out of every 5 policies. But different corporations, PE firms have different philosophies on when to make a claim. So some will make claims just to sort of try and erode the retention. There might be minor issues. Others are just making claims when there is a really severe issue. So 1 out of every 5, and you see more claims on obviously larger deals than you do the smaller ones. So.
I think AIG has I don't know if they've updated it recently, but they have a survey out that talks about that.
Yep.
Yeah, and I guess the one thing that probably is true that, the kinds of relationship-driven issues that may deter people from making claims, particularly if management is involved and they're working for you now, certainly, 9 times out of 10 don't exist if there's an insurance company.
Right.
So the kind of process, the internal feedback loop that may lead you to not making a claim against a management or a seller because there's still a partner or whatever, isn't going to exist if there's an insurance company.
Right.